Hash topic selection rationale asterisk asterisk. Chosen topic bail-in laws hash 4 asterisk asterisk. Why inflation 2025, bank fees, how to save money, and financial freedom are all trending on YouTube right now. The bail-in angle directly weaponizes the viewer's trust in their bank, the very place they're putting savings. It connects to the channel's best-performing signal, hidden financial threats, silent wealth confiscation, and pairs with the previous banking video without repeating it. The previous video covered how banks profit from deposits. This one reveals what happens when the bank asterisk fails asterisk. Your deposits are legally seized. It's the darkest logical sequel. Hash script, asterisk, asterisk title. They already made your savings legal to seize. Here's proof. Asterisk, 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 asterisk. In 2013, the government of Cyprus walked into every bank on the island, froze every account, and took up to 47.5% of deposits over 100,000 euros, overnight without warning, without a vote. That wasn't a robbery. It was legal, and the law that made it legal now exists in your country too. If this is your first time on this channel, hit subscribe and the notification bell right now, because the information we cover here is documented, verifiable, and almost never reported by mainstream financial media. Here's what happened. On March 16, 2013, Cyprus announced a bail-in, not a bailout, where taxpayers rescue the bank. A bail-in where asterisk your deposits, asterisk rescue the bank. Lakey Bank customers lost nearly everything above the insurance threshold. Bank of Cyprus depositors had 47.5% of their uninsured savings converted into worthless bank shares. People woke up on a Saturday morning and couldn't access their own money. ATMs were shut off. Banks stayed closed for 12 days. 12 days where you could not touch a single euro you had earned. And here's the part that should make your stomach turn. The European Union watched this happen, called it a success, and then built an entire legal framework to do it everywhere. Asterisk, 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 asterisk. In 2014, the European Union passed the Bank Recovery and Resolution Directive, the BRRD. It became law across all EU member states by January 1, 2016. Article 44 of this directive explicitly establishes that when a bank is failing, unsecured creditors bear losses, and under banking law, your deposit, the money sitting in your checking account right now, is classified as an unsecured loan to the bank. You are not a customer holding money in a vault. You are a creditor who has loaned your money to a corporation, and when that corporation fails, you're in line to pay. This isn't buried in obscure legal text. The Bank of England and the FDIC published a joint paper in December 2012 titled Resolving Globally Active, Systemically Important Financial Institutions. Page 3 states plainly that the strategy involves the conversion of unsecured debt, which includes deposits, into equity. Your savings become shares in a failed bank. The EU directive covers 27 countries and roughly 450 million people. But this isn't just Europe. Asterisk, 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 asterisk. In the United States, the Dodd-Frank Wall Street Reform Act of 2010, Section 2, Title 2, established the Orderly Liquidation Authority. This gives the FDIC the power to restructure a failing, systemically important financial institution. And restructure includes converting creditor claims. Your deposit is a creditor claim. In Canada, the 2013 federal budget, page 145, Economic Action Plan 2013, explicitly introduced a bail-in regime for Canada's 6 largest too-big-to-fail banks. The Canadian government published this in plain language. It says, and I quote, "The government proposes to implement a bail-in regime for systemically important banks." Australia updated its Banking Act through the Financial Sector Legislation Amendment in 2018, granting APRA, their banking regulator, enhanced crisis resolution powers that include bail-in provisions. The UK established its own bail-in framework under the Banking Act 2009, amended in 2014 to comply with the BRRD. The Bank of England confirmed bail-in as the preferred resolution strategy for major UK banks. This is not a conspiracy theory. These are published laws passed by parliaments, documented in budget papers. The legal architecture to seize your deposits in a banking crisis exists in every major Western economy right now. It's already built. It's just waiting for the next trigger. Asterisk, 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 asterisk. Now you might be thinking, I have FDIC insurance. I'm covered up to $250,000. And technically you're right. But let's look at the math. The FDIC's Deposit Insurance Fund held $128.2 billion at the end of Q3 2024. Total insured deposits in the U.S. banking system exceed $10.5 trillion. That means the fund covers approximately 1.2% of what it promises to protect, 1.2%. If just two major banks failed simultaneously, not even a full crisis, just two institutions, the fund would be depleted. And during the 2023 banking crisis, when Silicon Valley Bank and Signature Bank collapsed, the FDIC had to invoke the systemic risk exception to cover uninsured deposits, meaning deposits above the $250,000 limit. They covered them that time. That was a political decision, not a legal guarantee. There is no law requiring them to do it again. The FDIC itself publishes annually that its target reserve ratio is just 2% of insured deposits. They haven't even hit their own target, and that target would still only cover a fraction of a real systemic crisis. Asterisk, 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 asterisk. Before 2008, the playbook was bailouts. Taxpayers paid, banks survived. It was ugly, it was unpopular, but your deposits were never directly touched. After 2008, governments globally decided, never again will we use taxpayer money. Sounds noble, right? But they didn't say we'll let banks fail. They said we'll use a different source of money. That different source is you, your deposits. The Financial Stability Board, an international body that coordinates financial regulation across G20 nations, published its key attributes of effective resolution regimes in 2011, updated in 2014. Attribute 3.5 explicitly requires jurisdictions to have bail-in powers. Every G20 nation is committed to implementing this framework. That's 20 of the largest economies on Earth, representing over 80% of global GDP, all agreeing that depositor bail-in is the new standard. They shifted the risk from the government's balance sheet to yours. And they did it in budget documents and regulatory frameworks that nobody outside of banking law ever reads. Asterisk, 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 asterisk. So what does this look like in practice? If your bank fails and a bail-in is triggered, here's the hierarchy. First, shareholders get wiped out. They lose everything. Second, bondholders take losses. Third, and this is where it gets real, unsecured creditors, including depositors with amounts above the insured threshold, have their money converted into equity in the failing bank. You had $400,000 in savings. Now you have shares in a bank that just collapsed. Those shares could be worth pennies or nothing. And even the insured portion isn't instant. During the Cyprus crisis, people couldn't access insured deposits for nearly 2 weeks. Imagine, your rent is due, your mortgage payment is due, your kids' school fees are due, and your account is frozen because your bank is being resolved. This isn't fear-mongering. This is the documented sequence of events from Cyprus 2013, from the actual text of the BRRD, from the FDIC's own resolution playbook. Asterisk, 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 asterisk. Here's what you can actually do with this information. First, understand the insurance limits in your country and never hold more than that limit in any single institution. In the US, that's $250,000 per depositor per bank, spread across multiple banks. Second, understand that not all accounts are equal. Joint accounts, trust accounts, and retirement accounts each have separate coverage limits. Structure accordingly. Third, diversify beyond the banking system entirely. Treasury securities, specifically short-term T-bills, are direct obligations of the U.S. government held outside the banking system. They are not subject to bail-in. Physical assets, paid-off real estate, and allocated precious metals sit outside the bail-in framework completely. Fourth, stay informed. The Financial Stability Board publishes annual resolution reports. Your country's central bank publishes its resolution strategy. These documents are public. Read them. Because the people who wrote these laws are counting on the fact that you never will. Asterisk, 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 asterisk. The legal infrastructure to use your savings to rescue a failing bank already exists in every G20 nation. It's not coming. It's here. And the next time a major bank wobbles, the question won't be whether bail-in powers get used. It'll be whether anyone warned you first. If this video changed how you think about where your money sits, subscribe to this channel right now and hit the bell. We decode the financial systems that are designed to be invisible. Next video, we're exposing the two companies that secretly own almost every major corporation on Earth and how they got that power through your retirement account. You don't want to miss that one. #chapters for description. 0 o'clock. The Cyprus bail-in. What actually happened 1:30. The EU directive that legalized deposit seizure 3 o'clock. Every country that already passed bail-in laws 4:30. Why FDIC insurance won't save you 6 o'clock. The post-2008 shift from bailouts to bail-in 7:15. What a bail-in actually looks like for your account 8 o'clock. How to protect yourself 8:45. What's coming next? #shorts. Short one. **. In 2013, Cyprus took 47.5% of people's bank deposits. Overnight. Legally. No vote, no warning, no appeal. ATMs shut off. Banks closed for 12 days. You couldn't touch your own money. And the European Union didn't punish Cyprus for it. They praised it, called it a template. Then they passed a law making it legal in all 27 EU countries. It's called the Bank Recovery and Resolution Directive, and it turned your deposit into what regulators call an unsecured creditor claim. Translation: if your bank fails, your savings pay for it. Not taxpayers. You. And this isn't just Europe. The US, Canada, UK, Australia. Every G20 nation has agreed to implement this framework. The law already exists. It's just waiting for the next bank to fail. Short 2. Your bank deposit is not your money in a vault. Legally, it's an unsecured loan you made to a corporation. The Bank of England and the FDIC published a joint paper in 2012. Page 3 says deposits can be converted into equity during a bank failure. That means your $300,000 in savings become shares in a collapsed bank worth almost nothing. The EU made this law in 2016 across 27 countries. The US has it in Dodd-Frank Title II. Canada printed it on page 145 of their 2013 federal budget. Australia passed it in 2018. These aren't proposals. These are active laws sitting on the books right now, in countries holding your money right now, and they were specifically designed so that the next bank crisis doesn't cost the government a dime. It costs you instead. Short 3. The FDIC insurance fund has $128 billion in it. It's supposed to protect $10.5 trillion in deposits. That's coverage of 1.2%. 1.2%. If two major banks failed at the same time, the fund is gone. During the 2023 SVB collapse, the FDIC had to invoke a special emergency exception to cover uninsured depositors. That was a political choice, not a legal requirement. There is no law that says they have to do that again next time. The FDIC's own target reserve ratio is just 2%, and they haven't even reached that. Your deposit insurance is a promise backed by a fund that covers roughly 1 penny for every dollar it's supposed to protect. And the government already built a legal backup plan. It's called bail-in, and it uses your money instead. Short 4. Before 2008, when banks failed, taxpayers paid. It was called a bailout. After 2008, every major government said, never again. But they didn't say, we'll let banks fail. They said, we'll find a different source of money. That source is your deposits. The Financial Stability Board, the international body that coordinates rules for G20 nations, published a framework requiring every member country to have bail-in powers by 2015. That covers 20 countries representing over 80% of global GDP. They moved the risk of bank failure off the government's balance sheet and onto yours. They did it in regulatory documents and budget appendixes that no normal person would ever read. They are literally counting on the fact that you will never look this up. And until you saw this video, they were right. Short 5. Here's what a bail-in actually looks like for you. Your bank fails. Step 1, shareholders wiped out. Step 2, bondholders take losses. Step 3, your deposits above the insured limit get converted into shares of the failed bank. You had $400,000 in savings. Now you own equity in a collapsed institution. Those shares might be worth pennies or zero. And even the insured portion? In Cyprus, people couldn't access their insured money for almost 2 weeks. Rent due, mortgage due, kids' tuition due, account frozen. This isn't hypothetical. It happened. And the law that allowed it now exists in every major Western economy. So what do? Never hold more than the insured limit at one bank. Look into T-bills held outside the banking system, and stop assuming the rules that protected your parents' money still protect yours.